what is the thing you care about most in the next 72 hours?
No, a whole lot of nothing, right? I mean,
okay, thanks for joining us.
Sorry, I mean, just gotta be honest.
Next.
I mean, it'll be interesting to see what the Fed says. It'll be interesting what the BOJ says, the BOE says. But the bottom line is, in the UK, data's been a lot better than they would have expected. No need for them to go. The Bank of Japan, they just recently made some major changes. They don't know how that's going to go yet, so they're going to wait and see. The Fed, we have an election. I don't know if you know this, but we do have an election coming up relatively soon. They're not going to do anything major before the election. The market isn't expecting anything, so we're not going to see anything from the Fed. But they'll be setting themselves up for December when they probably will actually move.
And Peter, how much more can the Fed actually set themselves up for December? If I just bring up, WIRP on my terminal here real quick, it basically looks at December's already at 69, 70%. What more can they actually do?
Well, they can say two things. One, the employment cost index, which came out on Friday, indicates that their inflation objectives are moving towards 2%. The GDP inflator was there, and their unemployment level is down to where they should be. It's almost, I would say that percentage is probably too low, and the probability of a hike in December is much higher. The question is, does this put them on a path towards normalization? Not towards rising rates, because aggregate demand is still a little weak, but they should have done this sooner, in my opinion, and I think they're going to start in December.
Well, and what does normalization look like? Forget about December for a moment. Let's assume that that's baked in. What does 2017 look like in a normalized world?
In a normalized world, it should probably raise 2 to 3 times, and the rate should probably be 1.25% to 1.5%, given where inflation is and inflation expectations.
So you come down on one side of the debate that appears to be going on within the FOMC. On the one hand, we don't want to kill the golden goose right now. We want to keep this growth going. On the other, we got to worry about overshooting and really having some problems with inflation.
The issue with the golden goose is, and I try to get this one line in every time I'm here, monetary policy is defense, fiscal policy is offense. The golden goose has to be what's going on our fiscal policy. We have a continuing resolution that expires in December. What happens? I think you just mentioned there's an election next week.
There is.
Yeah, so what happens there and what goes on with the Senate and the House and those dynamics?
Well, and Michael, if we take a look at that GDP number that we got on Friday, let's back out trade and back out what we saw in terms of inventories. And growth is really what, 1.4%? I mean, what kind of overheating do you think the Fed's going to want to see?
Oh, I mean, it's not great, but at least it's positive. I think that what you said next year, 2 to 3 rate increases for normalization, that's still pretty glacial, right? You're not talking about this really fast 300-400 basis point tightening cycle. So I think that's justified with what we're seeing. I mean, the data's trending in the right direction, but you're not going to be really confident if you're the Fed to go more than 2 or 3 times next year. So that makes sense. And that's really what matters. Let's face it. If the Fed moves in December, that's not going to really do anything to markets. What matters is how much the markets expect the Fed's going to do next year. If the probability of 2 or 3 rate increases go up significantly, that's when you see a movement in the asset markets, not just on a single rate.
But even 2 and 3 rate increases, though, you're still looking at monetary policy divergence, and that will have some kind of ramifications for asset classes. Somebody. Michael.
And FX.
Right.
I mean,
across the board, right, Michael?
You would, but I mean, it's still pretty gradual. I mean, you have seen some pressure on the dollar, which is some expectation of the Fed tightening, but I don't think the expectation of 2 rate increases, especially with the track record the Fed has right now of not following through, is going to do too much to move markets. You're really going to need to see economic data improve dramatically. You're going to have to see the probabilities of, multiple rate increases, 3 rate increases, let's say, go up next year to have a significant impact on rate markets or any asset markets. And, the Fed doesn't want to, if markets go too far in expecting the Fed's going to tighten, it could have a kind of adverse feedback loop preventing the Fed from actually going.
Complacency is far too high in the marketplace. You see that with the very narrow ranges. You also see in the deal this morning expectations that energy prices have actually bottomed. I'm not so sure where I see the evidence of that. You saw just a rally recently, but it didn't even take out the highs from June. I think there's far too much people saying, okay, status quo is all right, we're going to muddle forward. That is not my opinion, because I think that, as I just said, fiscal policy is nowhere, and that's a problem for the U.S. economy.
But that catch-22 feedback loop is what Goldman Sachs actually highlighted, David. If you take a look at the Bloomberg here, the blue line is the Bloomberg Dollar Index. The white line is a financial conditions index. The idea is, as you have the dollar move, you have financial conditions tightening. Are we in a repeat of what we saw earlier in the year and the end of last year, that winds up making the Fed hold off more than they even wanted to?
As confident as Peter is in the December hike, the question is, if the Fed really sees the dollar moving up, are they going to get a little nervous and they'll sort of back off a little bit? That's the question.
Well, the question is, what's the dollar? So against the euro, it hasn't moved at all. So that's a big trading partner. If you look at some of the leading commodity currencies, such as Australia and Canada, that's a sign of worry. But that's not necessarily Fed policy. That's the aggregate demand question and what's going on with commodity prices, and they're still relatively weak.